All right, good day, everyone. Welcome back to another daily analysis with the price action decks. So today we'll be doing something a little bit different. Instead of giving a daily analysis, which we had already given earlier on today. If you haven't watched that, please go back to that video and so you'd understand what I'll be talking about in this current video. So now we'll be talking specifically about an entry model. I do use personally, and lots of SMC IC traders do use as well. It's called the IC Unicorn model. It's a very high probability model. So it's a model that, if well understood, well seen, and well taken, it results in a high win rate trading series of trades. You understand? Now, what's a unicorn model? It's basically a specific price, price actions setup that combines two core ideas like the liquidity sweep and the breakout structure. You understand? We all know what a liquidity sweep or stop on is, and breakout structure. It's the core basis of this model. You wanting to see a liquidity sweep and a breakout structure. You understand? Now, why it's referred to as a new unicorn model is because it's a high probability setup. You understand? It's a high probability setup if done right. You understand? Now, the whole idea behind this is that the whole idea behind the unicorn model is that smart money is trapping traders, then revive price with strong intent. You understand? Basically, price the market's giving a false move, false break of structure, false idea, and reversing it against the retail traders following that false idea. You understand? So how to go about know this how it forms. It forms start by a liquidity sweep, price sweeping out old highs, old lows, double top, double bottom, previous section high, previous section lows, and so on and so forth. Then it comes next with a market structure shift. You understand? I'm going to play in a diagram so you can clearly see there's a buy scenario. This is a sell scenario. This is a buy scenario. It starts by, first of all, its liquidity sweep of previous high, break of structure, then you understand, break of structure. Then one extra aspect which is referred to as the entry zone is either, yes, where people do get it confused. Now, you can, when it first came out, the unicorn model, it was a breaker kind of model, meaning we all know what a breaker is, whereby the last the last leg before the liquidity sweep, once price trades back to that level, violates that order block, which is this level now, right here. A retest of that level, which can say a failed order block, regarded as the entry, which is regarded as a breaker block. You understand? Now, people do use that, and that's also right. But personally, I do have much more interest, much more trust in using the fair value gap after, or should I say, the fair value gap right before the liquidity sweep. When it's inverted, I'll use that as my entry. Exactly that's how I go about it. Understand? Now, the several confluences you can work with. You can use both. You can use a situation of using both the order block and what's it called? The fair value gap. You understand? When I say confluences, when you see the other block that was created has a fair value gap, it's likely going to be a high probability one when inverted. You understand? So basically, right here now, we're trapping traders. We are moving with so much strong intent, meaning we would not want to see price trade back to this level anymore, so as not to let those traders that were trapped here to get off without no loss. You understand? That's the whole idea of the unicorn model. You understand? So this diagram both illustrates the sell scenario whereby price takes up buy side liquidity, break structure, reverses, retest, or should I say, inverse a fair value gap around this region, and that could be an entry point. Or you can wait for price to retest the breaker after it invalidates the other block, and you can use that for entry. This is a buy scenario. Price sweeps out sell side liquidity, moves rotating, breaks, retest, and push higher. Now, here's the right now. It's like a simple model, like currently this is what I would refer to as pattern trading, because right here is all about pattern. Although it might have some smart money, what's it called, ideology in terms of liquidity sweep, break of structure. Yeah, it's just a pattern. See, no matter what sort of trade, but it's just a pattern. Now, what differentiates it from being a pattern is the idea of using a narrative. You understand? A narrative being that you would have a higher time frame view of price going down to the lower time frame, and you waiting for specific areas for this specific pattern to play show up. You understand? You can't just go into the market and look for an old high, or should I say, an high on the 1 hour time frame, 4 hour time frame that's being swept and this. No, it does not really work that way. You need to first of all know what direction the order flow is, what exactly you're expecting for that day. You understand? Before you would want to start looking for this pattern in the market. And take note, timing is also very important. You do not want to engage on this kinds of trade during time there, let's say timing that are not really favorable to, let's say, certain pair, or should I say that are outside the major zones, major sections. You understand? So you'd want to ensure you see these stuff occurring during a specific time frame. Then for those who trade lower time frames, we do have the 90-minute cycles for every section, 3 90-minute cycle. We all know there's an AMD structure. You'd want to most times you'd want to for high probability setup you'd want to see the AMD play out exactly like this, whereby the accumulation phase goes after the buy side liquidity. You understand? The manipulation phase goes after the buy side liquidity. Distribution is where you see the break of structure and entry. You understand? You can frame it that way. There are a lot of ways to go about this, but I'm just going to give you a straight on ahead and also show you a trade I took from today, and also how I took 2 trades today on gold during the London section and the New York section, and both had the same ideas. Although the second one during New York section, that was the entry. I used it as the entry. But for London section, it was used for buyers. You understand? I will explain as we go. Now, when I say narrative from the higher time frame, that's basically what I do day to day. When I come into the chat, tell you that, guys, okay, this is what I'll be expecting. I would want price to trade to this direction. That's my narrative. That's my bias. You can call it that. That's my narrative. I give narrative meaning you are giving room for error. I told you guys if I would want to invalidate my sell idea, I would want to see price close above a certain daily fair value gap. I told you guys if you've not seen that video, go back to it because I made myself clear. I would only want to see sales for today. I was so 100% on the bearish side. I stated that without indecisiveness. You understand? Now going straight to the chart. So you see, start from the New York, London section. So you see the trade we got from London section. Now, this is gold. The 1 hour time frame, you can see exactly what I said. Price sweeping out old highs. You can see this is the 1 hour time frame. This is the inverse. This is the fair value gap prior to. I'm going to use a rectangle. There's the fair value gap prior to price sweeping out our liquidity. Take note for those who've watched the analysis. That's the daily analysis. You would notice that before all this happened, I drew out this fair value gap right here, but using lines because I was watching to see how we trade around that level. Seeing how price balanced this whole move, we traded filling that gap, but went back to the top, the tip, came down, traded back to the consequent encroachment of the fair value gap and this place. I knew we had already established a balanced price range, and price was not really going to go there, so I was not expecting any more manipulations before my entry. All I just did for my entry was wait for a macro entry, and I think I've sent you guys a video about the macro entry, how to use the macro entry. You understand? And my trade was based on the 2:50 to 3:10 a.m. macro, New York local time. You understand? That's basically what I did during London section. That's how I got my trade, and my objective was basically the previous days, which is Friday's London section low, and that was my trade. London for New York, yeah, that's basically for New York. For New York, going down to the 15 minutes. Same idea. Take notes. I'll tell you guys exactly what these lines are. This line right here, I was taking note of the low of this fair value gap right here because if I was going to sell, I knew price was heavy on the sales. If I was going to sell, I would not want to see price violate this fair value gap. Take note. Remember, it's been stated the wicks do the damage, so the wicks can go as far as they want, but the bodies tell the story. Now the bodies clearly states right here that they are not really willing, they are not really violating that level. The wicks are just running higher, stopping out early sellers. You understand? So that's why that line is there. Then going down to the 15 minutes time frame during the New York section, this scenario by the New Unicorn model was used as an entry model. You understand? I told you guys on the 1 hour time frame, I used it as a form of getting a bias. You understand? So price trades back, swoop starts, old high, displace, reject, total soup, stop point, whatever you want to call it. Displace right here, closing, violating, closing below this fair value gap. A retest of that could be your entry. That could be your entry. Stops above here. An objective to the level, I think previous month low, or should I say previous week's low. That could be the trade, just simply based on the new commodity. But personally, for me, you notice I was on 5 minutes, and my entries are only on the 5 and the 1 minute. So I had a little bit of a refined entry than most people. I had a refined entry. It was based, yeah, I took note of that level as well. Also took note of this as well. And my stops were just above the fair value gap. And yeah, now, like I said, you can also make use of the breaker block. Now, this is the breaker block right here. The last down candle, or should I say the other block that was created while price was running towards buy side liquidity. You understand? This is buy side liquidity. And now that's other block, which is currently you can refer to that as a failed other block now. On the retest of the other block, you can take your entry at that level, stops above the fair value gap or above the midpoint of the fair value gap. Since you would not want price to stop, you would not be expecting to trade above the midpoint of the fair value gap to maintain your bearish bias. You understand? So entry there, stops above that level, target as usual. You understand? So it's a straightforward model, very easy to know, very easy to understand. It's nothing complex, very easy concept. Hold on, which is referred to as a unicorn model. On your own time, you can go through, do some research on your own to know how to use it. Now, there are various conferences I had, which I'm not really going to talk on here. Idea of what it is. I'm not really going to tell you how I do use it. Now, they are, for example, the macros. Regardless of using the unicorn model, I do ensure it's playing out during the macro timing. You understand? These are specific timing. I do trade. Most of my trades are occurring within a 20 minutes. Most of my trade entry are within a 20 minutes interval. They can last for hours, but the entries are within a 20 minutes interval, which I refer to as the macros. Understand? So it's a straightforward entry model, price sweeping out liquidity. Now, how can you use this? Let's say, for example, a day comes where I tell you I'm bullish on price. I want price to trade bullish higher. I might not give a target, but it's easy for you to get objective. Previous sections high, previous sections low, previous 90-minute cycles high, previous 90-minute cycle low, previous days high, previous days low, relatively equal lows. Those are objective that liquidity that you don't want to be interested in. Then for retracement case can be a discount PDRE or a premium PDRE. You understand? So what would you do? I'm expecting price to buy. Now, there's this phrase I do tell my students. If I would want to buy, whenever I tell them, or whenever I want the market to buy, I would want to see sell side taken out, meaning sell side liquidity being swept. That's the idea. If I want to buy, I would want to see sell side liquidity being swept. If I don't want to see buy side liquidity being swept. You understand? The only time I would ignore that one, if the market is very heavy or very strong, thereby showing me an SMT divergence. If there's no SMT divergence, I would want to see price sweeping a liquidity level prior to my entry. You understand? So that's the hack, or should I say that's the idea behind it. Now I'm just going to reference a little bit to what I mean when I said previous 90-minute cycle high. Now I'm going to pop up an indicator, which I think I've tweaked a little bit, which shows the 90-minute cycle for New York section. So you see exactly the level markets swept. Now the indicator is going to pop up. You can see. So took out the previous 90-minute cycle high, which is this. This was the I think yeah, was 90-minute cycle high, which we swept. Now the liquidity sweep, you would want them to occur at specific areas, not just a random high. You can't just pick this high. Okay, you want to see price sweep this high. No, not even stuff like that. You want to see that there are significant levels being swept, because the algorithm refers back to this level, and they are sensitive around these levels, not just some random high, random low. You understand? So when saying that, I know okay, they had swept a liquidity level that I'll be interested in wanting to see a reversal from. That's the idea. You understand? So that will be it concerning the unicorn model. If you have questions, do drop on the comments. I'll try and elaborate on it and give my replies as soon as I see the message. But take note, like I stated, people do use the breaker block entry for the unicorn model. Most people use the fair value gap, or should I say inverse fair value gap, for the unicorn model entry. Both are correct. You understand? Basically, just use whatever it's much more comfortable for you to use. I've been doing this for a long time, and I'm quite very comfortable. I can very well tell when the breakout hold and when it won't hold, and I would want to wait for that. And one of the ways I can, let me just give you a tip. I don't really say this, but whenever the fair value gap comes in as a balanced price range, I will definitely want to expect price straight back to that fair value gap when it occurs as a balanced price range. To that, when it occurs as a balanced price range basically, using this example, when two fair value gap overlaps, understand, a bullish fair value gap and a bearish fair value gap overlaps, that would create a balanced price range, and that's a very strong range. You would want to study on your own personal time when two levels, two fair value gap overlaps. Now we have a bullish fair value gap right here, and we have a bearish fair value gap right here. Now the one we refer to as the first initial fair value gap that was created, that level is referred to as a balanced price range. And yeah, when it that the fair value gap chose that way, most times I'm more interested in the balanced price range than the breaker block. That's one hint I've given it to you guys now. So that will be all for today. Do have a nice day, and yeah, trade safe, and I'll see you guys tomorrow on the daily analysis.